Welcome, welcome. My name is Bruce Fraser. I'm your host for this epic event. And let us start with talking about some very important organizations that have made this event possible today. And this is a program, the first program of 2022 for the International Federation of Technical Analysts. This is a federation of independent technical analysis communities, societies around the world. And we provide content both as individual societies and as a group through our IFTA.org affiliation. And we want you, this first event of the year is an event for everyone. This is actually a tradition. We started this at the Technical Securities Analysts Association of San Francisco, where every January, as a membership drive, we would have this event with our speaker today. And so we are very excited to extend this event, this tradition to the entire IFTA organization. A very big thank you for our collaborator on this, which is StockCharts.com. StockCharts.com, StockCharts TV, and the wonderful group there that is going to basically process this program and make it available both on the StockCharts TV channel and then also for IFTA to be able to show this on our website. So thanks very much to StockCharts. We hope to have ongoing collaboration with this incredible service. This is a wonderful data visualization service website where you can do just about anything in terms of being able to do your data visualization, stock charting, financial market charting, and so on. And so please, please check it out. And I think you'll find it to be quite useful, quite impressive. And then also for you people that are not members of IFTA, but you want to be a member of a community of like-minded people, do check out the IFTA.org website. And there is a society that is somewhere near you in the world. And you can go right here to membership, go to member societies, and you can click on this and you will see the societies throughout the world where they are and see the website, link in, and learn more. So please go check that out and become a member of IFTA with a society that really appeals to you, because this is a most phenomenal organization, and we think that you're going to just continue to have tremendous growth in your knowledge base through being involved in these types of organizations, as is today's event. We have as our special guest today, the one and only Martin Pring. Martin is an extraordinary educator in technical analysis. He's written one of the most important books on technical analysis in our generation, which is Technical Analysis Explained, and has written a number of very important books. He writes an incredible market newsletter. You're going to see some of his work that goes into that newsletter today. And so we are very excited to have him. I consider Martin to be literally the father of econometric technical analysis, and I think you're going to see why today in the incredible work that Martin does. And so without further ado, let us get started and talk to our very special guest for this year's presentation. A traditional event of the San Francisco Technical Analysis Society is to have Martin, who actually would come to Golden Gate University and speak and present an outlook for the year ahead. And we wanted to be able to extend this out to the StockCharts.com community and the IFTA.org or the IFTA community. And so this is incredible that we are able to do this with StockCharts support. And with that, Martin, welcome. Thank you so much for doing this for us.
Thank you very much, Bruce, and thank you for those kind words.
Well, Martin has been a friend and a mentor to me for, gosh, nearly 40 years now, and I feel very blessed. So let's get started.
Okay, well, the subject of today's talk, of course, is the outlook for 2022. And the first part is concerned with US equities. And I'd like to start off by summarizing a couple of the points I'm going to be talking about. And I put this one in red. Inflation could be a problem for stocks, because I think that's the biggest threat stocks face in the next 12 months or so is rising inflation. And we'll get into that and the reasons for that. The second point is the secular trend for US equities is bullish, but the primary trend is getting a little overextended. And we may have some problems at some point during 2022. The US market, which has been outperforming the rest of the world for the last 8 to 10 years, I think is expected to do the same thing. I see no changes in that trend favoring the US stock market. However, I do see a change, a very important change taking place in the relative action of the technology sector. And of course, that will have wide implications for the market as well. So we'll get into that. But first of all, I wanted to show you a slide that sort of demonstrates basically how important the economy is to the stock market. Because if you're going to get a sustainable bear market lasting a year or more, year to 2 years, it's likely to happen under the auspices of a recession. And so you can see that the 5 big bear markets that occurred during this whole period all occurred during under the context of a major recession. And we also get slowdowns when the growth rate of the economy slows down but doesn't actually contract. That causes stock markets to suffer some selling as well, but the declines are usually limited to 10 to 20%. That's the kind of thing I would be expecting to happen this year at some point. I'd also like to make the point that if you're watching this on a mobile phone or something, these are very long-term charts, and you may not be able to see the dates. So all the dates are included at the top of each chart up here, so you can get some idea of the range of the data being displayed. And the second thing is that I'll be showing a lot of vertical lines and arrows. And the solid ones represent signals that work with the idea or the technical indicator that I'm talking about. If you see a dashed arrow or a dashed line, that means that in that particular instance, the indicator is not working. So we talked a little bit about the cyclical side of the stock market. Let's now take a look at the very long-term or secular trend, because the secular trend is very important to understand its direction or make some effort to understand its direction, because a rising tide lifts all boats. So in this chart here, which we're seeing in the top window, the inflation adjusted S&P, and in the red highlight bearish periods during recession. I should say it highlights recessions, and during a secular uptrend, there are very few recessions, and they tend to be very mild, and the corrections tend to be influenced by the slowdowns in the economy that take place. Whereas during a secular bear market, as we had just here, you can see that there were lots of recessions, and some of them were quite steep. Also on the chart is the Shiller PE or CAPE ratio. It's called CAPE because it's cyclically adjusted. And that means that it's calculated over a 10-year period. The earnings are calculated over a 10-year period to try and eliminate some of the cyclical patterns that take place. So it is very nicely set up to follow secular trends. So in this case here, you see at the beginning of the 1900s, we had a peak in the ratio, and then it zigzagged down into 1920, and that happened. That was a secular bear market, and then we had a secular bull market going into 1929, and the pattern repeated itself, or has repeated itself ever since. moving from secular bull to secular bear. Now, this is regarded as a fundamental indicator, but I regard it as a sentiment indicator. Otherwise, how can you explain the situation where in 1929, investors are willing to pay $32 for each dollar's worth of earning, yet 3 years later, they were literally throwing stocks away at $6 for a dollar's worth of earnings. It doesn't make sense unless you bring psychology into the formula. So the Shiller, in my view, is a great indicator for telling us whether people are optimistic or pessimistic. And when they get too optimistic, that's the time to be worrying about problems in the stock market. Right now, you can see the indicator, or the PE is up close to its all-time high. Now, I think level is important. A high level is important in the sense that the higher the level, the more vulnerable the market's going to be, because that means that if you get to a high level, a lot of people have had a long period of time in order to make careless decisions about their investments. So there's more to unwind. So from that point of view, the level is important. But I think trend on a shorter term basis is more important than level, because as long as the trend is up, you can stretch that elastic and keep stretching that elastic until you finally reach the peak. So the next chart shows the Shiller itself with a long-term KST from 1995 to 2022. In case you're not familiar with the long-term KST, just think of this as a smooth long-term momentum, similar to a slowed stochastic or an MACD indicator. It's just trying to bring out the cyclical trends of the indicator that's following. And you
can read about, sorry, Martin, you can read about the KST in the StockCharts school on the website, and also you can actually draw your own KSTs, which is Martin's indicator. You can actually draw those from the StockCharts charting engine.
Yeah, absolutely. That's of course where this was taken from. So anyway, here's a more up-to-date picture of the Shiller, and you can see that when we're talking about the trend of the indicator, you can see it broke out from a very big base, a 16-year base 4 years ago. So it started to rise a little bit now. But and the other thing is we still see a series of rising peaks and troughs. So the secular uptrend is still intact. But what we're seeing now is the fact that the KST is kind of flattening out a little bit. And you can see it in the past when the KST has rolled over, we've seen a move down in the Shiller price earnings ratio. And so we're very overextended at this point with the KST, but it's still in a bullish mode because it's still rising and it's still above its moving average. If that starts to crack and the PE itself drops below its 12-month moving average, that will be the time I will begin to get concerned. But until that happens, I think it's okay on the upside. Another way of looking at the Shiller price earnings ratio is to compare and think about it as a return on stocks and compare it to a current yield on Moody's BAA corporate yields. So in other words, it's a stock bond ratio looking at yields. And the idea here is that when it's rising, it means investors are favoring stocks until it reaches above this red line, becomes a little overextended, and then starts to reverse. That indicates that stock market's likely to run into trouble, as you can see from these arrows here. So traditionally, this line here represented a nice benchmark that when it was reversed, when the indicator reversed from it, that indicated the stock market was going to suffer. And you can see that happen pretty consistently from the 1930s onwards. There were a couple of situations recently where we've had a failed situation, hence the dashed arrows. And now the indicator is way above its normal overbought level, like just about everything else. And we can draw a trend line joining the bear market low with the 2020 low. And when that gets violated, that would be obviously a serious technical setback. Also, if it broke below the moving average, that would be the same thing. But it's obviously going to take a long time to get to the traditional selling mode where it moves below the overbought line. So another way of looking at this is to treat the Shiller price earnings ratio, the Shiller ratio with the BAA corporate yields, treat that as an oscillator. And that's what we do in the next chart. So in the top window, we have the inflation adjusted S&P. And in the lower window, we have the Shiller versus the Moody's 615 EMA. In other words, it's the percentage price oscillator using a 6-month parameter divided by a 15-month parameter. And when the 6-month goes below the 15-month series or moving average, then we cross below this red line here at 0. And what we find is that when the oscillator is trading below 0, we're going to get one of these pink shaded areas. And you can see what happened in this particular instance of the 2002 bear market. But the inflation adjusted stocks dropped quite dramatically. So here are all the other periods when it's been below below 0. And all of them have been associated with a decline. Sometimes it's been a little bit late that most of the decline has has already happened. But in most situations, when the oscillator goes below 0, it's a serious technical development on the negative side.
So I take it, Martin, that when the Moody's yield index starts to go, the yield goes up, that's one of the conditions that creates a headwind for this oscillator and can cause it to turn down.
But it must be relative to the Shiller PE.
Right.
That is correct.
And so they sort of dance together, and so this would be one of the conditions that would cause this ratio to turn downward.
If it turns, then I turn bearish too. But right now you can see, Bruce, that it's at a pretty heady level here. So it's going to be some time before that indicator crosses below 0. I should add also that you can apply this technique to virtually any market. It works reasonably well most of the time. Nothing's perfect. There is no holy grail, but it does work consistently well quite a bit. I've got a chart later on to show you of the gold, and it's experienced very few whipsaws over the years, but it's captured most of the advances and declines in gold. So anyway, moving on and going back to the idea of the market's overstretched. Here's a little rate of change here. It's 120-month, 10-year rate of change. And this is, again, the inflation-adjusted S&P, and it goes back to 1815. So it's quite a long-term chart. The idea here is that when the moving average starts to reverse from a high level, that's when we get one of these red arrows. And in every situation here, you can see that the secular trend of the stock market went into negative mode. And there, of course, as an old thing, some false signals. So here's a couple of false signals here where the market didn't respond on the downside. But by and large, when you get up to this heady level, you want to be a bit careful on the stock market. It's not the same as when it's down here. That when it's down here, everyone's pessimistic. And it's obviously, especially with the benefit of hindsight, a great place to be thinking about buying. But up here right now, the moving average is overstretched, but it's still rising. So it hasn't given a sell signal, but the elastic is very, very finely, it's stretched to a great deal here. So we have to be careful, and especially with interest rates rising and inflation on the rise, which we'll talk about later, that can be a problem.
Martin's long-term historical charts that go back into the 1800s and even beyond are just remarkable. I mean, your perspective in the long term is unparalleled. So it's just fantastic to see charts like that.
Well, I was very lucky. I inherited a very good long-term database, Bruce, but I find it very useful to go back and look and see what happened in the past, not just the last 5 months or 10 months or 2 years, but to go back much further, because you get a much bigger perspective. And here's one of those perspectives. At the top, we've got the inflation-adjusted S&P. And underneath, we've got a price oscillator of industrial commodity prices in the US. And that price oscillator compares a 60-month moving average with a 360-month moving average. And that's the indicator that's plotted in the bottom panel here. Now, the actual indicator has been plotted inversely to correspond with swings in the index. So you can see that when commodity prices are falling on a secular basis, that's pretty good for stocks. And when the commodity prices are rising, because remember, this is inverted, that's not so good for stocks. And that's what these red and green highlights represent. When it's green, it means that the indicator, the oscillator, is above its moving average and turning down. So in other words, what that means is commodity prices, because this is plotted inversely, commodity prices are on a secular decline. And all the way through, that's represented that way. So when I put up these arrows now, you can see that in most of those situations, or pretty well all those situations, when commodity prices start to rise on a secular basis, one needs to get a little bit concerned about stocks. In this case here in the 1930s, you needed to be concerned immediately, and the same time in the 1970s. Whereas we saw a false signal in this period here in the 1990s, and there was a 4 or 5 year period of rising stocks following the signal. So it's not a slam dunk that stocks are going to get into trouble when the secular trend commodity prices reverses, but it does put you on a kind of level that if you're looking up, putting up 5 or 6 red flags on the field to turn bearish, this would be one. And last month, you can just barely see, but that went red. And it's obviously another sell signal has been triggered for stocks as the buy signal for commodities is signaled. And we'll turn it up the right way and go into commodities during the part 2 of this presentation.
You certainly don't get whipsaws in this indicator.
Well, there's just that one there. And
yeah,
that's it.
But yeah, when it turns, it turns.
Years. It's not too bad. So I talked a bit about inflation. This chart here goes from 1880 to 1949, so it's not up to date. And the vertical lines show you cyclical peaks, or I should say the vertical lines show you when the CPI hits 5%. That seems to be a troubling spot for equities, because if you look to the right of the vertical red lines, the solid ones anyway, you see that prices not only decline, but you also get one of those red highlights. And that red highlight there indicates, or all of them indicate a recession. So usually when inflation reaches the 5% level, one needs to be concerned about the potential for a recession. And if that actually materializes, then stock prices are going to come down. Now, right now, I'll show you later on that a couple of indicators that I follow are not even close to getting near a recession. So I'm not expecting a recession to take place here for quite a while, but I don't rule out the possibility of a slowdown. So here's the same arrangement, but this time we've gone from 1949 up to last week. So the CPI here is again featured, and we've got our line at 5%. And when it touches 5%, that's when it spells trouble for the stock market. In this case here in 1990, we had a recession and the stock market had already experienced it doesn't look much on this chart, but it was quite a serious decline. And so that looks like it was a failed signal, but it actually wasn't. What was a failed signal was that one in 1953, when rates went up, or the CPI went up as high as I think it was 9.5%, and it didn't adversely affect the stock market. And there was no recession until 1953, which is at least a couple of years later. So right now, what you can see is that the inflation rate is well in the warning zone of 5%. So how do we know that inflation is not going to continue? Well, we don't, but some of the pointers that I look at suggest that the inflation rate is going to move higher from here. So you can see some vertical lines here. Those are intersecting with the peaks in the annual inflation rate. And this time we're looking at core inflation, which excludes food and energy. If you look up at in the upper window, you can see that we've got capacity utilization. And if you look to the left of the vertical line, you can see that capacity utilization typically peaks ahead of the peak in consumer price inflation. That's what these green arrows are pointing to. And if you look at the current situation here, you can see the capacity is at a new high or at the moment. So there's no sign of any weakness in capacity, and therefore, based on historical precedent, it seems unlikely that the CPI rate will be coming down anytime soon. Also, it's just broken out of this huge secular trading range here, going all the way back to the mid-1990s, and that suggests higher prices as well. An interesting thing happened to me over the weekend. I was talking to my partner at Pring Turner Capital, Tom Copas, and he was telling me that they're putting out he's putting out his quarterly newsletter, or our quarterly newsletter, and he thought it would be a great idea to compare 1977, when the firm was founded, with the current situation today. He had a lot of statistics which he shared with me. I don't want to take away his ideas, but I do want to share a couple of statistics with you. And that is in 1977, the December inflation rate was 6.77, and the money market yields, the December 1977 money market yield was 6.64. Today, the inflation rate is exactly the same, 6.7, and money market yields are close to zero. Obviously, something has to give. Rates have to go up in order to kill inflation. To give you an idea of the perspective of 1977 on this chart that we just saw, this red arrow just here approximates the point at December 1977. I'm not forecasting that we're going to have another 3-year rise into as we had here, but I do make the point. I think that with the zero rates, or almost zero rates, that until that is taken away, that punch bowl is taken away, we have the threat of higher inflation. So I mentioned before that I didn't think there was a recession on the horizon, and this chart kind of demonstrates that with these two indicators. One is the yield curve, where we measure or calculate the difference between, or the ratio between, the 10-year and the 1-year. And the idea here, once again, is that the red highlights represent the recessions. And in order to bring on a recession, typically what has to happen is you've got to have a period of tight money. And that's where the 1-year yield begins to grow, gain, I should say, against the 10-year paper, until we get to a point where the curve is what we call inverted, where it moves below this red line at 1.0. And if you see what happens, every recession along here is preceded by the yield curve inverting, and it's inverted sometimes for several months or more before it starts to cause, the tight money starts to cause recession. Well, look at the current situation. You can see that the yield curve is a long way even from inverting, let alone hanging around the inversion period, the inversion area for several months. So that very reliable long-term indicator, consistently reliable indicator of recessions, is obviously a long way from signaling a recession. The second thing I want to see for a recession is for this Pring-Turner recession caller to go down below the recession line, just slightly below the zero level. In the past, this momentum indicator of an actual leading indicator has, when we've reached a recession, it's been very close or below the red line. Sometimes it's been a little bit below, and sometimes a little bit above, as it was in 2000, a little bit late. But generally speaking, we don't have to worry about a recession until it comes pretty close to that recession line there. And obviously it started its descent, and it doesn't rule out a growth recession where the rate of growth comes down and doesn't go below zero, kind of like this situation just here in 1987. But it does suggest that a recession is not on the horizon.
Is there a way for the attendees to be able to sign up for this quarterly market letter that Pring Turner puts out.
Yeah, just go to pringturner.com and you can sign up for our mailing list there, and you can receive that report. And you'll also be able to see these charts as well. There'll be a PDF file up there.
Oh, fantastic, because I know that people are now very interested in reading more about this relationship that you just showed. And so it's great that they can get that quarterly letter. Thank you.
And this kind of stuff is also featured in our monthly intermarket review as well from pring.com. So moving on now, look at the global situations. It's the Dow Jones Global Index, stock index, and it's been adjusted by the G20 CPI, which is about the best global CPI number I could come up with. And the idea here is that the indicator or the index broke out from a huge base going back to 1999. It broke out a couple of years ago or a year ago or so, suggesting that prices are probably headed much higher before this secular bull market is over. And already you can see that we've got a series of rising peaks and troughs that are intact. The problem is that the long-term KST, or the long-term momentum in the bottom window, is overstretched. And you can see what happens when it gets overstretched and starts to go negative. That's consistently signaled some kind of a bear move in global stocks. Sometimes it's been a relatively small one, like this one here, and others like the financial crisis and the 2002 bear market, 2000 to 2002 bear market. It's quite serious. That indicator right now is still bullish because it's above its moving average, but it has started to turn over, and it is overextended. So it does suggest that we could be on the cusp of some kind of a corrective activity in world markets. Note also that the moving average here, which is a 12-month moving average, is at 1.99. At the end of last month, the index, the CPI adjusted index or G20 adjusted index, was at exactly 1.99. An amazing coincidence. So there's not much room here, not much leeway for downside action before we start to trigger some bearish signals. That was an arrow there is to show you that the indicators, like all other indicators, is not perfect, and it failed in its negative signal. So the curve is that KST is flattening and looking as though it's about to roll over for a momentum sell signal. So this chart here relates the MSCI World Stock Index, a different world index this time, and it relates it to the OECD amplitude adjusted leading economic indicator. This is actually a derivative of that indicator. And you can see that the chart at the top is split into green, black, and red highlights. The red highlights occur when the oscillator, the derivative, is below its moving average, and the stock market is also below its moving average as well. And we get a green highlight when both conditions are reversed. They're both positive. So there's a positive stock market and there's a positive economic indicator. And black occurs where they're in conflict, which is what we have now. We have a black conflict because the economy is weakening in a growth sense, but the index is still above its moving average. Now, the index at the end of last month was 105.78. I clocked it in at 104 and change earlier this morning, and the moving average itself is at 100. So it wouldn't have to come down that much to trigger a red highlight. And as you can see, the red highlights have not necessarily been persistent bear markets, but they've certainly been times when the stock market or global equities have suffered.
Now, Martin, do you publish that indicator in your monthly newsletter from time to time?
Yes, in fact, it was in last month's issue, Bruce.
Interesting. A reason to be a subscriber.
Oh, there's thousands of reasons.
Exactly.
Anyway, end of the commercial. So here's another indicator that suggests world stock prices may be in a little bit of trouble here. This is a 104-week ETF diffusion indicator where we take a basket or a universe of country ETFs traded in New York, and we calculate the percentage that's above 104 weeks, which is 2 years, of course. And when that gets to be overextended and starts to come down again and crosses that overbought line, that gives us a sell signal for the world, so to speak. And you can see that it's consistently been bearish correctly, except for one false signal just there. Now you have to be very careful when you look at some of these visual charts, and I'm guilty of it myself, that you see the sell signal and you see the thing coming down. But between the time when you get the sell signal and the time when stocks actually suffer is several months. So just because you get a signal doesn't mean to say that it's going to be negative at that particular point. For that, it's going to sell off at that particular point. But what it does tell you, as you can see, we're gone negative again. What it does tell you is that you need to be a little bit more careful than you would have been otherwise, because you are subject of probabilities. At this point, we've got 1, 2, 3, 4 signals that worked, one signal that didn't. So the probabilities favor at some point the market correcting a bit more. And that we don't know how much that will be. One of the things I've always thought of is that prices are determined by the interaction of a number of different time cycles. And when we measure a rate of change, like we have a 9-month rate of change in the second panel here, it's only measuring the cycles around that 9-month period. So it would be ideal to try and figure out how, if we could have an indicator that was dependent on lots of different and widely differing time frames. And then all the cycles will be in gear in one direction or another. And that's how I developed the idea of putting 3 rates of change on a chart with differing time spans, 9, 12, and 18, representing different time cycles. And if you can see that they all line up with a trend line break, and that is then confirmed also with the price, and the confirmation is very important. You must have momentum confirmed by the price. Then that gives you a pretty good chance that you're going to see an important change in direction of the trend. You can see the same thing here. Excuse me. And another one over there. And then we get a triple break there. And that confirmed the breakout as well that had taken place before. And in the current situation, we have a mild break. I mean, I call these breaks pretty good because they're long-term trend lines. They've been touched a lot of time, and they're pretty obvious places where you can draw the trend line. Where in the current situation, you've got two of the trend lines have already broken, and they're not very long. They're only about 2 years, and one's right on the cusp. And if you want to look for a confirmation, we can't really draw a trend line. It'd be far too steep. So then we come back and look at the moving average, and the moving average is at 543, and the price at the end of last month was 574. I don't know what it is right now. It's going to be below 574, but I would use that as more as a signal than using a trend line that confirm this potential weakness in this momentum. The US and against the rest of the world has gone in 3 very important trends since the 1990s. There was an uptrend in the 1990s up to 2000 or so. There was a downtrend. And then since 2008, 2010, it's been an uptrend. In other words, an uptrend favors the US, a downtrend favors the rest of the world. And underneath, we've got my 615 model that we looked at before, where we look at a 6-month exponential moving average divided by a 15-month exponential. And when we go below 0, that's when we get one of these pink shaded areas. And you can see that it's caught some fairly negative moves, and it hasn't gone negative for a very long period of time. There was one false signal, which I put in gray, and that occurs just there.
It really shows an epic secular bull run.
It is, and it still looks like it wants to continue, because look at the indicator compared to its moving average here, or to its 0 line. It's moving away from 0, not towards it.
And it's pointing straight up.
It's also above its 12-month moving average, which you can't see because the moving average is covered up by this trend line. So in other words, they both reinforce each other as a support level. The trend line is one level of support, and the moving average is another one. So my conclusion is that the US is going, as far as I can see, or as far as the eye can see, is going to continue to outperform the rest of the world. I see no signs of that reversing at this point. And now finally, I'd like to end up with a chart that I featured in the Intermarket Reviews, our chart of the month last month, because I thought it was kind of interesting. We're looking at the top against real stock prices, and underneath is a ratio between computer hardware and energy. In other words, we're looking at a proxy for technology and a proxy for and the energy index, S&P energy index. I had to use hardware because I wanted to take this back to the 1940s, and that's the only technology index that I can find. It goes back that far, so it's kind of proxy for the whole industry. So the thing to notice is that we've got the real stock prices in the upper window, and these approximate the secular trends of real stock prices in the US. And underneath is the ratio between computer hardware and energy. And what you can see is that if I drop that down, there's a pretty close connection between the secular trend of real stock prices and the ratio between computers and energy. There is an exception, and that was in the 1980s. But by and large, the relationship holds quite well. So if you know what computer hardware is going to do against energy, that provides you one piece of evidence that might possibly indicate that the trend of real stock prices might be in the process of reversing in whichever direction that takes place. So this relationship is also quite trendy on a very long-term basis, where you can draw nice secular uptrends and downtrend lines. And then when they're violated, you get a pretty nice move in the ratio itself, which gives you an indication of what the trend in stock prices is going to be, except during that 1980s period. So we can draw another line here, and you can see that the ratio is just a little bit above its secular uptrend line starting in 2008 there. And you can also see that the momentum has peaked from well over 200%, and it's definitely peaked and is around a zero level right now. And what I found with my research is that whenever a market or a relationship exceeds over an 18-month period, because there's an 18-month rate of change, exceeds 200%, and the momentum indicator has clearly peaked, then it's an average of about 15 years recapture period until you get back to the old highs. In other words, here's an example of it now, because it reached nearly 400% back in 1999. But the inflation-adjusted stocks didn't recapture those gains for about 13 or 14 years. And I found this principle has worked on pretty well every market that I can follow in my extensive long-term database. And so this looks in jeopardy of a major change in flavor from computers towards energy, or technology towards energy. You see a kind of a peaking in the NASDAQ relative strength line against the S&P. And in this chart here, in my final chart, this is the NASDAQ, which is a proxy for technology because it's dominated by technology, against the SPDR energy ETF, the XLE. And you can see this is taken up to the 5th of January, and it's just completed that head and shoulders top, meaning that if the top works, and that's not a false break, that the energy prices are likely to improve over the NASDAQ for quite a long time, because that's a 2-year top. And bearing in mind the previous chart, which is close to a sell signal for technology, for hardware, it seems to me that if these signals are valid, then we've seen last year, which was the peak, saw a secular peak in the relationship between the NASDAQ or between technology and energy. That completes what I have to say, Bruce.
Well, this really does maybe create headwinds and problems for the Fed, as this could impact CPI going forward. and also producer prices if energy starts to become a dominant theme in the markets.
Well, the interesting thing is that technology companies are beginning, as I see or perceive, are beginning to become the target of government regulation. Energy companies are the target of government regulation, whereas in the case of technology, that regulation is going to depress margins. In the case of energy, it's going to increase margins because it'll increase shortages. So there's a rationale for why this change in theme is taking place.
Wow, this could be a real problem for the Fed to deal with as they try to get CPI under control. And interesting. Well, Martin, we are not even done yet. You just saw the end of part 1 of this event, and part 2 will be coming. We will be recording it a little later, but at the conclusion of part 1, we thank you for being here, for attending, and you can see why I like to call Martin the father of econometric technical analysis, because just nobody does it better. And incredible work, incredible research, and your time and wisdom is just so greatly appreciated. So thank you, Martin. Oh,
thank you, Bruce.
And let me just say, Pring.com, go to Pring.com to learn more about the intermarket review, where you can see many of these indicators and many more on a monthly basis. And then PringTurner.com to be able to sign up for the quarterly newsletter. And with that, we'll say goodbye and thank you so much for being here, and we will see you for part 2.
Thank you, Bruce.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.